Okay, so hello, my dear future chat accountants. I hope everybody is doing great. Is my voice audible? PPT visible? Can you please confirm it once? Yes, thank you. So, this is a new chapter, liquidation of companies. Before we go to the problems, let me just first take you through overview of this chapter, and then, as usual, we'll go for problems. Okay, so what do you mean by liquidation of company? Okay, liquidation. What is the meaning of it? It's simply the means of the process of closing down or winding up of the operations of the company, closure, that is liquidation. And what is the types of liquidation? Broadly, we have two types. One is voluntary liquidation and another is compulsory liquidation. Voluntary liquidation means it's like suicide. You only go and die. Compulsory means somebody will come and kill you. Not like that. Voluntary means company thought, okay, we have done with the affairs, we have done with our objectives. Now we would like to close it down. Compulsory means court might say it, or tribunal might say it, or some other case would have been filed, or inability to pay debts. You are not in a position to make the payment. Inability to pay debts. These kind of things can be possible. And what are the laws? Regulatory compliance is applicable. Two types of compliance are applicable. One by Companies Act, various sections are there. Another is IBC, Insolvency and Bankruptcy Code. Over a period of time, actually, this Companies Act provisions are getting moved towards IBC only. Some definitions are there, some procedures are there, but mostly, gradually, everything is moving towards insolvency and bankruptcy codes provision. These are legal applications of it. Then types of problems. What we are going to have? We have to do statement of affairs problems. Then we will have liquidators final statement of accounts, liquidators final statement of accounts, and B list of contributories. Now, this concept of B list of contributories is now not in presence. Even study material don't have it, so we will not consider. If time permits, later we will do one problem. If time permits, just to understand what was it. In case they ask in exam, I doubt they cannot ask because um, it is presently not in practice. Even companies that don't have provisions relating to that. These are the types of problems we can do it. Okay. What are the other elements to be considered? Especially, what are the types of creditors? Types of creditors. We have discussed types of creditors. So we have secured creditors. Creditors, I mean, don't think only suppliers, outsiders, liabilities. Even employee is an outsider, even landlord is an outsider, government is also an outsider. Okay, secured creditors. Secured creditor means they have some security in the sense like they have some charge, hypothecation, mortgage loan, etc. Then we have overriding preferential creditors. Then we have preferential creditors. And then we have other unsecured creditors. Now, apart from secured creditors, everybody else is unsecured only. But within them, you have to give them preference. So, who are preferential creditors? Preferential creditors are payable to government in the form of taxes. payable to government in the form of taxes within 12 months from the date of winding up. Payable to employees, wages and salaries. Wages and salaries. And only for less than 4 months in last 12 months. Only 4 months salary in last 12 months. And not exceeding amount notified. And amount notified is, they said, 20,000 per person. As of date, that is amount notified. Then you have other payables like ESI payable, PF payable, investigation expenses, etc. Compensation expenses, etc. And this is again within 12 months. Everything is in last 12 months. From the date of winding up, you can only go back to 12 months. If it is beyond 12 months, that is not preferential creditors. Overdue preferential creditors means there are some specific list not required for exam, like workman compensation. And they are always paid in preference to other, paid in preference to others, paid in preference to others. So when you make a payment, you first make a payment to secured creditors, of course overriding preferential creditors because they are the in preference to others. Then even though preferential creditors like payable to government in the form of taxes, payable to employees in the form of salary, wages, bonus are unsecured in nature, they have to be paid first, preferential creditors. Remaining, if any, you'll be paid to other unsecured creditors like bank loan, unsecured. Then you have a payable to landlord rent, a supplier payment, any other form of payments will be unsecured creditors. Okay. Okay. Now, okay. So what is the order in which you are going to make a payment? First, you always make a payment to secured creditors. Then you make a payment to preferential creditors. Of course, overdue preferential always be paid first. Then you pay to unsecured creditors. When I say creditors, liabilities. Then you pay to preference shareholders for preference share capital and for preference share dividends. And then you pay to equity shareholders. Okay, this is the order. Then process of winding up, we have two things discussed: statement of affairs and then liquidator's final statement of account. There are a lot of provisions like what are the resolution to be passed, what is the procedure to be followed, what are the filing to be made, statement to be filed. All those things you learn in CA final level in detail. In insolvency bankruptcy code is there, a companies act is there. Here I'm not going to discuss that, but broadly what is required is every liquidation process, you require the approval of court, right? Therefore you have to submit a estimation as regarding what are the assets you are having, how much it is likely to realize, how much payment you have to make it to your creditors, how much surplus will be available to equity shareholders, like that. That estimation is called as statement of affairs. Statement of affairs. And ultimately on final settlement, when everything is over, you have to submit liquidator's final statement of account. So this statement of affairs is estimation, whereas liquid final statement of account is actual. Formats are different, but both talks about how much receipts from your assets and how much payments to your creditors and how much balance available regarding your preference shareholders and then equity shareholders. This amount available, the process of amount collected, amount payable, everything is summarized. So statement of affairs is an estimation, whereas final settlement is liquidator. Now who is liquidator here? Liquidator is a person appointed either by company or approved by the court. Means liquidator is a person who is responsible for looking after the closure of the business, like which assets to be realized, auctioning it, selling it, collecting the money, making the payment to employees, making the payment to outsiders, landlord, making sure they are having amount is secured or unsecured, like that. So person who is looking after the closure of the business is called as the liquidator. Okay, now uh, statement of affairs will have 8 lists. What are those lists? List A will have particulars of property which are not specifically pledged, which are available for making the payment after realization, of course. List B, assets which are specifically pledged, meaning you have mortgage of loan, you have given the papers of land and building, hypothecation of stock, pledged in favor of creditors, fully secured or partly secured. Preferential creditors like for taxes, salary, wages. Debenture holders having floating charge. Floating charge means not specific charge. They don't have specific charge on this particular computer, this particular machinery. They have floating charge on all the computers. That is floating charge. Debenture holders. First charge, second charge, pari passu charge. You would have heard these terms in your company law. Unsecured creditors means who are going to payable next. That is after paying all the outsiders, all the preferential creditors remaining available, unsecured creditors. Even after paying them, remaining is given to preference shareholders, then paid to liquidity shareholders, then the deficiency account or surplus account. In the sense, when you don't have sufficient payment, you have to make a payment of 80 lakhs to the creditors, but you have only 60 lakh. 20 lakh could not be paid. And you know, unlike partnership, the 20 lakh you cannot collect it from the shareholders, because shareholders will have a limited liability. The amount that could not be paid to the outsiders is called as deficiency regards with respect to creditors. Even you may not be able to pay preference shareholders, that's called as deficiency with respect to preference shareholders. You may not be able to pay your equity shareholders, that's called as deficiency with respect to equity shareholders. Sometimes you might make surplus money, more money than what is payable in the balance sheet, then it will be called as surplus account. So that is the list you have to prepare. The format of liquidators, the format of statement of affairs look like this. You don't have to take it down, just take a look at this. Anyway, in the problem we are going to solve it. So it will have two parts. First part is regarding assets. The second part is regarding liabilities. One amount on the left side, one amount on the right side. Now for assets we write only on the right side, we don't write anything on the left side. For liabilities we write left also, we write right also. I'll show you why. You start from assets first. Okay, this is assets portion. This is assets. Then we come to liabilities. Assets portion, you start from assets not specifically pledged, list A. And here you write estimated residual value. Why estimated? Because it is submitted at the time of winding up. The winding up is not completed yet. Before you get the approval, you have to submit documents. You are doing an estimation, projections. That's why it's estimated residual value. Asset not specifically pledged, machinery, stock, building, other assets, current assets, whatever may be the list. Asset specifically pledged, you have taken a mortgage loan on land and building, let's say. So realizable value of the building, let's say 30 lakh. Realizable value of the building is 30 lakh. And due to secured creditor, let's say 28 lakh. So you have now extra 2 lakh. That extra 2 lakh can be taken to the last column, XXX, because that can be now paid to others. What if is it not 28 lakh? If it is secured is 32 lakh. That is they are partly secured creditors. You cannot pay them in full. You have a deficiency of 2 lakh. The deficiency of 2 lakh will be now called as unsecured creditors. Because out of 30 lakh, 32 lakh, 30 lakh we realized, balance 2 lakh, they become just like any other creditor. They become unsecured creditors, and that will go to the unsecured totals. Total will be there, that will be added. Then this much at this point in time you get estimated total assets available for all liability payment. That's what it gets. Then gross realizable value of assets dispatched and other assets. This is only for reference purpose, we write it. But this will not be considered in total purpose. This amount should tally with gross liability later. I'll come to it later. When you do problem, you understand better. Okay. So secured creditors, as per list B, you will have this amount. We write it secured creditors, we write amount here, but we don't write amount here because secured creditors are already paid. The amount paid we already considered here, so they don't come here. What about unsecured creditors portion? If they are not fully paid, they will come in unsecured creditors. Secured creditors, to the extent which claims are paid, with our gross liability here, and don't write the amount in the realizable value column. Then preferential creditors like demand for excise duty, GST payment payable to government, uh, that will amount you write it here. Now this is the amount available, let's say 1 lakh, and you make a payment to the preferential creditors, let's say 10,000, remaining 90,000 we say balance available for debenture holders having floating charge, remaining balance. So the process of statement of affairs is what? We will have the amount, available, you make one payment, remaining amount will be there, you make one more payment, remaining amount will be there, you make one more payment, like that you keep paying one after the another until you make the payment to the equity shareholder. So amount available will be there here, you pay the preferential creditors, you will have balance amount, then you pay debenture holders, then you pay unsecured creditors as per list E. Unsecured creditors means what? The trade creditors, the unsecured loan, trade loan, or liability for contingent, everything is there. So this much when you make the payment, hopefully you'll be able to make the payment. If you have any shortage, you can call it as deficiency. Otherwise, you can say balance available for preference shareholders. Balance available. Then whatever the payable to the equity shareholders and preference shareholders, if that also cannot be paid, then total amount is the what do we say? Total deficiency regarding equity shareholders as well. So if you're not able to make the payment to the outsiders, if you have deficiency regarding creditors, obviously you will not be able to make the payment to preferential shareholders or equity shareholders. So that also will add to your deficiency. Whatever amount that could not be paid is called as deficiency. So overall statement of affairs format. Don't worry, when you do the problem, you'll get a better idea of it. Liquidator fund statement of account is nothing but, in simple words, though it's in a ledger format, it's more like receipts and payments. Receipts and payments. Okay, so you write it as two bank account, two cash account, opening balance, all the assets realized is amount received, and realization of assets pledged minus secured loan, because secured loan means you will have some pledging hypothecation, you make the payment, only surplus will available, the outer column. Then if you have any partly paid up shares, money received from them, and to operational earnings till the winding up is done. If a company is doing some operations, some cash generated by business activity. Then payment made to legal expenses like legal charges, liquidators remuneration, liquidation expenses, debentures having floating charge, interest or outstanding accrued both, preferential creditors, then unsecured creditors, then preferential holders, preferential capital and preferential dividend, and then you pay equity shareholders. This is the order in which you have to make the payment. This is the final statement of account. After completing all the process, the liquidator should prepare how much money he has collected, how much money he has paid, ultimately what is the balance. You observe in this list, we don't write secured creditors. We don't write secured creditors. The reason being, we have already subtracted here secured loan. So in the payment side, secured creditors will not come. Okay. Now, sometimes, as I told you earlier, one second. Okay. Now, sometime what happens, these debenture holders who are large in numbers, they say we want a special person to look after our liquidation process. The person appointed specifically for debenture holder is called as, what is he called as? Any idea? Is called as receiver. Is called as receiver. So before you prepare the liquidate fund statement of account, a receiver will prepare an account. A receiver will prepare, let's say, receipts and payment account, where you will write two uh, assets realized, because some of the assets where floating charge is there for debenture holders, those assets are sold by receiver, a specially appointed person. Two assets realized, whatever the amount, and by payment made to debenture holders, and whatever is surplus, by surplus carried forward to liquidator. So what does basically receiver do? He will sell the assets belonging to debenture holders, receive the money. Money he received, he will make the payment to debenture holders. Any excess amount or surplus amount, whatever case the case may be, will be transferred to liquidator. In the liquidator account, you can also write one more line: to amount received from receiver, the surplus amount received from receive. This amount also will be available. Okay, now. Uh, Sometimes what happens, they'll tell you liquidate remuneration as a percentage. Liquidator remuneration payable as a percentage of payment to creditors. As a percentage of payment to creditors. So there are two cases possible. One, sufficient money is available, sufficient money or sufficient amount available to make payment to creditors. In such case, what do you do? Whatever the amount paid to creditors amount due multiplied by the percentage divided by 100, whatever liquidator remuneration percentage. But if money is insufficient to pay creditors, like you have to make a payment of 50 lakh, but available only 20 lakh. Now, can I say on 20 lakh, let's say 1% is payable? On 20 lakh, 1% payable means after paying a creditors, you will have only, after making the payment of liquid remuneration, 1%, balance amount will be less only. It should be on the amount payable to creditors. So, unless we know the amount payable, we will not be knowing liquidator remuneration. Unless we know liquidator remuneration, we will not know how much balance available. This is the problem arises when insufficient money is there to make the payment to creditors. In such case, what we do? We follow the method, simple method. We take the creditors, whatever the amount available, multiplied by whatever the liquidator percentage divided by 100 plus percentage. That is how liquidator remuneration is obtained. What is the logic behind this? If I have 100 rupees, I have to pay 3 rupees liquidators. That means total amount available should be, I should have 100 rupees to make the payment to creditors. I should have 3 rupees to make the payment to the liquidator. Total I should have 103 rupees. So 3 rupees out of 103 rupees, so that 100 will be remaining on 103% will perfectly 3 rupees. So we do 3 by 103, percentage by 100 plus percentage. This is the formula for payment made to liquidator remuneration when the money is insufficient. If the money is sufficient, we can do percentage by 100. Okay. Now, then situation happens where amounts paid up are different, where equity shareholders will be multiple class, like partly paid up shares. So amount paid up is different in equity shares. So different classes are there. Then how do you distribute? We are going to do by column. Two methods are possible where face value is same but partly paid up. Example, face value 10 rupee, face value 10 rupee. Then here we say fully paid, I mean 10 rupee paid up, fully paid up, face value 10 rupee, 10 rupee paid, and face value 10 rupee, 8 paid up. Another case is where face value is different but fully paid up. For example, face value 10 rupee, 10 paid up, and face value 5 rupees and 5 paid, fully paid, 5 rupee fully paid. In that case, when it is partly paid up, we follow the method called as notional call methods. Remember, notional call method. So what do we do in notional call method? We have amount available plus amount available by sale of the assets after making the payment to creditor, surplus available plus notional call. What is notional call? Which converts partly paid into fully paid. Partly paid into fully paid. Whole divided by number of shares, all number of shares. This will give you the amount to be paid, value per fully paid up. Value per fully paid minus whatever the amount not paid, notional call per share, notional call will give you the value per share of partly paid up. So basically, fully paid up ratio comes to 8 rupees, let's say 15 rupees, and notional call is 2 rupee in this example. So what those partly paid up people have to do? They will receive 15 rupees and pay 2 rupees. Receive 15 rupees, assuming 15 rupee fully paid up value, receive 15, pay 2, effectively they can receive only 13 rupees. That is what is face value partly paid up. Fully face value different means no notional call. We follow the method of equivalent units method. Equivalent units, no notional call. So whatever amount available divided by number of equivalent shares. Number of equivalent share. What is equivalent share? If 10 rupee paid up and other 5 rupee paid up, other face value 5 rupees. So face value 5 rupees, what do? We divide by 2, because having face value 1 share is equal to having half share of 10 rupees. You can convert vice versa also. So having this 1 share is equal to having this 2 shares, or having this 1 share is equal to having 0.5 share of this, right? Because having, if you have, let's say this is 1000 rupee, 1000 shares are there, 1000 shares of 5 rupees becomes 5000 rupees of 5 rupee paid up. If I want 10 rupee paid up, that 5000 rupees divided by 10 will give you 500 shares. So 1000 shares of 5 each is equal to 500 shares of 10 each. That's how we follow equivalent units method, and we get the value per equivalent share. Value per equivalent share. That is in this case 10 rupee paid up. Then you divide it by 2 or whatever the ratio, divided by the ratio. In this case, divided by 2, you get the value per other face value, value per normal share. Like in this case, you get value per 5 rupees paid up. In this case, we don't follow any notional method. So in the, what is the technical point to remember? When the face value is same, partly paid up, the two kinds of shareholders you have, the difference should be same. Difference in amount should match. But here it's not the difference in amount, it's the ratio of paid up amount should match. Ratio of paid up amount should match. Okay, so this was the overall summary of liquidation process. So what is the meaning of liquidation? What is the process? What type of problem can be solved? Type of creditors, liquid statement of account, then statement of affairs, and liquid statement of account. Two specific things: liquid remuneration as a percentage payable, and then partly paid up shares, how it is to be considered. Fine. So we will take up some problems on these areas. Okay, so moving on to next problem. So please come to this problem. Summarize balance sheet of Full Stop Limited on 31st March 2012 being the date of voluntary winding up is as under. Share capital, cumulative preference shares, equity share capital, 5,000 shares of funded each, 60 paid up, 5,000 shares of funded each, 50 paid up, security premium, debentures, preferential creditors, bank overdraft, trade creditors, land building, machinery, stock in trade, book debts, P&L accounts. Then information. Preference dividend is in arrears for 3 years. By 31st March 2012, assets realized were as follows: building, stock in trade, plant machinery, book debts. Expense of liquidation are 86,000. Remuneration of liquidator is 2% of the assets realized. Income tax payable on liquidation is 67,000. Assuming the final payments were made on 31st of March 2012, prepare the liquidator's final statement of accounts. Okay, so we'll prepare the columnar format. So have the format liquidator's final statement of accounts. Have the simple T format. Liquidator's final statement of account. Any working notes, we'll do it below. Okay, so all the assets realized. What are the assets realized? Land and building 6 lakh 20, stock in trade 3 lakh 10, plant and machinery 7 lakh 10, book debt 6 lakh 60,000. So land building 6 lakh 20, stock 3 lakh 10, plant 7 lakh 10, book debt 6 lakh 60,000. So these are all the amount realized. Please write down. Write down. Okay. Now this is the amount realized. Now payment, first you should make a liquidators, legal expenses, liquidation expenses, and then you will have liquid remuneration payable. Let's account for it one by one. In that order only we have to write down. Expense of liquidation 86,000, remuneration 2% of realization of assets, income tax payable on liquidation 67,000. Let's pay all these amounts. Okay. So by liquidation expense 86,000, 2% of the assets realized. Total amount, if I do, I get 23 lakhs, and 2% of 23 lakhs, that is 46,000. Then all the payment payable, debentures holder, preference creditors, Preferential creditors in the balance sheet also they have given. Preferential creditors 1,05,000 is preferential creditors, and even income tax payable what you have is also preferential creditors. That is also preferential creditor. In addition, you can write down. Then you can pay unsecured creditors, other people, overdraft, creditors from the balance sheet. Overdraft 4,85,000, trade creditors. Write down. Okay. Now, to whom do we pay next? We have to pay to shareholders. And who comes first? Preference shareholders, fully paid, 5 lakh. We can make the payment, I believe. Make the payments. By preference shareholders, uh, 5 lakh. And they also said, preference dividend is for 3 years. 3 years means how much? 5 lakh into 10% into 3 years you have to make a payment. Of course, if amount is available. So 5 lakh into 15% for 3 years. 10%, sorry. 5 lakh into 10% into 3 years. That's how you get 1,50,000. Okay. Now balance, equity shareholders, we have 51,000. But to whom do we pay first? Anyway, write down till here. Then let me tell you about the equity shareholder settlement. Okay. Now come to equity shareholders portion now. Who are there? One set of people 50 paid up, other set of people 60 paid up, and more importantly face value is same. When the face value is same, what method do we follow? Please tell me. We have discussed during basics. Face value is same, but one is 60 paid up, other is 50 paid up. Please tell me what method we follow when the face value is same but amount paid up is different. Which method? What is that method called as? Yes, it's called as notional call method. Notional call method. And notional call method means we will convert partly paid up into fully paid up. You can do in two methods. 60 rupee paid, 50 rupees paid. Both of them face value 100. So balance 40 rupees there, 100 minus 60. And balance 50 rupees there, 100 minus 50. We can call both. Or difference 10 rupee, only that also we can call. Both way it's fine. But let's stick to the basics. Let's call full amount. Okay. So amount available now. Amount available, we have 51,000 rupees. We have calculated also balancing figure. And we have equity shares of 5,000 shares of 100 each, but 60 paid up. Balance 40 rupees will collect, notional call, assuming it to be received. 5,000 into 40 rupees. 5,000 into 40 rupees, that is 2 lakh. Then another 5,000 rupees there. 5,000 shares, 5,000 shares, not 5,000 rupees, 5,000 shares. 50 paid up. Balance 50 rupees will collect. That is 2 lakh 50,000. So what is the total amount now? Please tell me. 51,000 plus 2 lakh plus 2 lakh 50,000. How much you get total amount available? 5 lakh 1,000. So total amount available 5 lakh 1,000. Total number of shares 5,000, 5,000, 10,000. So value per share fully paid up. Fully paid up. 5 lakh 1,000 divided by total number of shares 10,000. How much it comes to? 5 lakh 1,000 by 10,000. 50.1. 50.1. So this is if you are fully paid up. So you will receive 50.1. So you receive 50.1 and a partly paid up share has to make the payment. Then we do the balance net amount. How do we calculate that? So value per share for 60 paid up is from 50.1. What is not paid, subtract. The balance 40 rupees, notional call. At 40 rupees, we will subtract. So that is 10.1. Correct? Then value per share 40 paid up is in 50.1 subtract, or 50 paid up, 50 paid up. This balance 50 rupees you subtract this 50 rupees. So they will get only 0.1. They will get 0.1. Okay. So 5,000 shareholders who have 60 paid up will get how much rupees? Effectively 10.1. That is how much? I think 50,500. And another 5,000 shares who are 50 paid up, they will get only 0.1, which is 500. The total will add up to 50,500. Okay, so this is what is liquidator final statement of account is all about. Okay, now hope everybody is clear on this notional call method. This is how we take care of partly paid up shares. Fine. Let's go further. Okay, so come to this problem. Come to this problem. The position of Priceless Limited on its liquidation is as under: issued and paid up capital 3,000, 11% preference shares of 100 each fully paid, 3,000 equity shares of 100 each fully paid, 1,000 equity shares of 50 each 30 paid up. Face value is also different and partly paid up. Both are there. Nice problem. Calls in arrears 10,000, calls received in advance 5,000, preference share dividends in arrear for 1 year, amount left with the liquidator after discharging liabilities 4,13,000. Articles of Association provide for payment of preference share dividend in priority to return of equity share capital. You are required to prepare liquidator's final statement of accounts. Okay, read the problem once more. Okay, let's prepare liquidator final statement of accounts. It's more like a receipts and payment accounts. Let's see some space for working notes if required. So receipts will be on the debit side, payments on the credit side, whatever amount realized. Costs in arrears, costs in advance, assume that it is paid and received, assume that. So two assets realized. You don't have to write two because it's not a ledger, it's just a statement. But we like the T format, so I'll use the words two. The exam, you can ignore that letter TO, two. Amount left with liquidator after all liabilities 4,13,000. Okay, so 4,13,000 after all liabilities, 4,13,000. Then calls in arrears. Assume calls in arrears received. Calls in arrears. Calls in arrears 10,000. And assume calls in advance is paid. Calls in advance is paid 5,000. Okay, so before we pay to the equity shareholders, first you have to prepare the preference share dividend. So buy preference shareholders, preference share dividend, preference share capital. Preference share capital 3,000 into 100, 3,000 into 100, which is 3 lakh. And preference share dividend, dividend in arrears for 1 year and the rate of 11%. So 3 lakh into 11%, 33,000. Okay. So what is the amount available now? Please tell me. 4,13,000 plus 10,000 minus 5,000 minus 33,000 minus 3 lakh. How much? Balance amount available. Amount available to equity shareholders. $85,000. 85,000. The beautiful point about this problem is you have partly paid up shares as well as notional call. Partly paid up and notional call. So what we should do here now, we have to apply both the methods. Apply notional call and what method should we use when the face value is different? It's partly paid up and face value different. Partly paid up and face value is different. So we apply notional call and equivalent units method. Equivalent units method. So first you apply notional call. Applying notional call, you get how many shares? 50 to 30 rupees. So 20 rupees not paid up on 1000 shares. 1000 shares into 20, 20,000 plus the amount available 85,000. Total amount available 1,05,000. That equivalent number of shares. Equivalent number of shares. How much? 1000 rupees 50 paid up, but I want equivalent of 100 rupees each. So 1000 rupees into 50, but I want 100 rupees. So how many shares it comes to? 1000 into 50 divided by 100. I think you get 500 shares, right? So 1000 shares 50 each is same as 500 shares 100 rupees each, plus fully paid up shares are there, which is 3000 shares, so that comes to 3500. The value of fully paid up share is how much? 1,05,000 divided by 3500. How much rupees you get? 30 rupees. So this is what fully paid up people will get. Then proportionate for 5 rupee face value and partly paid up. So 5 rupee face value fully paid up, 5 rupees face value fully paid up. How much you get? 30 rupees for 10 rupee paid up. Proportionately you take 30 30 rupees for 10 rupee. How much for 5 rupee? Proportionately 30 into 5 by 10. 15 rupees. 15 rupees. But this is for fully paid up. But in the 5 rupees, sorry, not 5 rupees. Yeah, not 5 rupees. This is 100 rupees. So into 50 by 100 actually. Same answer. This is 50 rupees fully paid up. But 50 rupees only partly paid up. 50 rupees 30 paid up. 20 rupees short. So in 15 rupees minus 20 rupees, that is minus 5. Minus 5 means what? These people has to pay. So here we write to amount collected from partly paid up shares. Amount collected from partly paid up shares. 5 rupees to be collected on 1000 shares. 5 rupees collected on 1000 shares. That is 5,000. Then amount paid to equity shareholders. Equity shareholders, fully paid up people, which we calculated. 15 rupee they should get. How many shares? 3000 shares. 3000 shares to 15 rupees, 45,000. Not 5. Okay. 30 rupees you got. No, sorry. 30 rupees you got. It's not 15 rupees. 30 rupees they got. 30 rupees they got. Into 13 rupees you write. They got 30 rupees. See, 30 rupees. So 3000 into 30, 90,000. And see if the ledger tallies. See if the ledger tallies. Okay. Hope we can go further. Okay. Hello, my dear chartered accountants. Can you please confirm? Is my voice audible and the PPT visible? Yes. Thank you. So we finished various concepts and chapters. Now it's the time to do a chapter called as non-banking financial companies, NBFCs. Non-banking financial companies. So you would have learnt in banking companies chapter what is the primary purpose of bank: accepting deposits for the purpose of lending it to public. That's what they do, bank, right? So banks essentially their business activity is banking business. So they accept deposits from public like saving bank, current account, fixed deposits, and they will lend it to public. They give loans to public. And this activity is also called as the banking business. Now, what NBFC does, they cannot accept deposits from everybody. They have restrictions. They can lend it to public, but accepting deposit is restricted. Accepting deposits is restricted. They can, but they cannot with everybody. There are some rules and regulations to be followed who accept deposits. And they can lend, of course, to public. They can do other activities as well. They are called as NBFC. What are examples of NBFCs? LIC Housing Finance, Muthupuram, Manappuram, Muthoot Finance, Manappuram, Diwan Housing Finance, so various NBFCs. They are essentially a companies, non-banking financial company. So these companies, primary objective, or even equipment house financing companies, primary objective is not a banking business, but we say it is a financing activity. Financing activity. And they might lend, they might loan company, you might say, or they might invest. Even in a way, venture capitalist funds, they invest. They are also like NBFCs. But in a normal parlance, venture capitals are not NBFC because they're exempt from registration. But even in a way, they're also NBFC. Even hire purchase, leasing companies, equipment financing companies, the objective of starting that organization is to provide agricultural equipments to agriculturers on lease basis. That is the primary purpose of the company. So non-banking financial companies means they cannot take deposit from public, restrictions are there, but they can do all these activities, that is financial activities, are called as the financial service. There is a primary difference between a bank and a NBFC. Bank definitely does banking business. NBFC does not do banking business. They also give housing loan, but the objective of the company itself is only housing loan. They cannot do anything else. They can't give personal loan. LIC housing finance, they can only give housing finance. They can't do anything else. Restricted deposits, restricted application. So I give you various example. Muthoot Finance, Manappuram, Gold, they give personal loan. They can only give that, not nothing else. So these are called as NBFC. Okay, hope you written the basic structure of it. Now we'll write down definitions, whatever RBI has given, and what is registration rules, all those things we'll discuss now. Okay, now let's come to definition of it. So what is NBFC? It is a financial institution, is a company, financial institution, which is a company, principal business of receiving deposits under a scheme, and principal business of accepting deposits but restricted, meaning under a scheme, under an arrangement, like a debenture, under a scheme. And it might be a loan company, it might be a investment company, it might the company to give loan, company to investment, make investments, investment company, hire purchasing company, equipment leasing company, hire purchasing, equipment leasing company. Remember, it's all company first of all, so there has to be a registered under Companies Act. Equipment leasing company, or even mutual benefit company for the purpose of mutual benefits. That is, a company formed for taking care of certain people, certain people's assets. Mutual benefit company, like a cooperative bank, but it's not a bank, so mutual benefit company. And they cannot do any other trading business. And recently, they have one small amendment took place. That is, this is together asset finance companies, investment companies, loan companies. This loan company, investment company, and this equipment financing company, equipment leasing, put together. Loan company, investment company is called as investment and credit company. These two are called as investment and credit company. Okay. So what is basic difference between bank and NBFC? Let's try to understand. Basic difference between bank and NBFC. They can accept demand deposits. Demand deposit, repayable on demand. Can accept demand deposit. That is, demand deposits payable on demand. Cannot accept. It's part of settlement system. They can issue checks. Banks can issue checks. That is, they are part of uh, settlement system that NBFC cannot. The deposit insurance, in case the money is lost by the bank, there is some called as deposit insurance available for deposit holders in bank. In case money is lost, like S Bank, this deposit insurance will give the money back. Deposit insurance available for holders. NBFC not available. Okay, so banks do banking business, whereas NBFC do financial activity, only restricted financial activity. Okay, now hope you have written down regulators of NBFC. Regulators. It is definitely a company, definitely registered under Companies Act, to be registered under Companies Act, and to be regulated by RBI. Regulated by RBI. But certain companies are exempted. Exceptions are there or exemptions are there. Exemptions for RBI registration, not for company registration. Okay, because why exemptions are there? Because they are regulated by a separate act, separate statute. So type exemptions available from RBI because they are available, they are regulated by a separate company, separate statute, separate law. Like housing finance companies, LIC housing finance, they can register but they are exempted because they are regulated by National Housing Bank, NHBs. They are regulated by National Housing Banks. Merchant banking companies, banking companies who does the business of demat services, like they do SDFC, asset management company, those kind of things. Merchant banking, or they become underwriters, registrars to issue, those kind of things. Underwriter commission, underwriting services. Merchant banking are regulated by SEBI, Security Exchange Board of India. They are regulated by separate act. Therefore, they are not covered under this RBI registration exempted. Venture capital fund company, VCF, venture capitalist, VC, venture capitalist funds, again regulated by SEBI. Then insurance companies, because there is a separate authority, IRDA, Insurance Development, Insurance Regulatory Development Authority. They take care of it. So many more companies are there. These are the few examples of list where they are governed by a separate statute. Therefore, they are not required, exempted to register under RBI. All other type of companies must be getting registered under RBI. Okay. Who are then? What are the remaining people to be applied? Everybody remaining to be registered. What are to be registered? Uh, Asset financing company, equipment financing company, hire purchase, lease, asset financing, lease, then investment. We call together. What is the name we have given? We have given together one name. Investment Trade Company, right? What is the name they have given? You have just now written. Uh, Investment and Trade Company, ICC. Investment and Trade Company. That's what is we classified. So investment, uh, housing financing, not housing financing, asset financing, like vehicle loan, personal loan, those kind of investment company, infrastructure company, loan financing company, uh, microfinance company, infrastructure debt financing company, all these things, whatever we have learned, loan financing, loan company, all these things. Everybody else should be registered with RPL. even infrastructure company. Infrastructure company. Okay, many more definitions are there. If you want, you can go to study material, but too many things is there, so that's not required at this stage. I'm not covering it. So, okay. They also have to maintain net owned funds. I'll come to what is net owned fund means. Uh, the liquid asset requirements are there. They have to maintain minimum level of liquid like SLR for banks. This NBFC also will have. Okay, now for the purpose of all our definitions and applications of law, for regulations purpose, different kinds of provisions are applicable. We have this classification of NBFC for regulation, for applications of provisions. RBI directions applicable, not applicable, like that. We have mainly three groups. Okay, the first we call it as deposit taking. Deposit taking NBFC, and not deposit not taken, no deposit no deposit, non-deposit taking NBFC. So publicly they don't accept non-deposit taking NBFC. Taking deposits taking NBFC means they accept deposits from public. Non-deposit means they take money from only restricted people under a scheme, under arrangement. Whereas depositing NBFC means they can take money from public. Under this, we have two more varieties. One is called as systematically important, systematically not important, systematically important. Is a SI, systematically important, not systematically important. NSI. How do we define systematically department, systematically not department? How definition comes? What is the criteria? The criteria is net worth. Systematically important means net worth more than or equal to rupees 500 crores. Obviously, not systematically important means net worth less than 500 crores. Less than 500 crores. What is the logic behind this? You are a deposit taking, so you are an important company. You will have more regulations, more restrictions. You are not accepting deposits from public, but your net worth is more than 500 crores. You are also very important. You are like a public figure. Again, you are subjected to more regulations, more restrictions. Not systematically important, deposits not taking, banking, non-banking, non-systematically important. Three nons. What non? Not what you take in hotel. Three nons. What are three nons? Non-banking, non-deposit, non-systematically important. Non-banking, not deposit taking, non-financial, non-systematically important. So everything is non. You are a small company, so you are subjected to less regulation. You are subject to less regulation. So keep this more in mind. So deposit taking and systematically important, both of them will usually have a more regulatory mechanism common to both, whereas non-banking, non-systematically important, non-deposit, three three non, remember like a three non-banking, non-deposit, not systematically important, they are subject to less regulation. So even though three varieties are there, so these two I'll put together and say one type big company, and these are small companies. So more restrictions for big companies, more regulations, less restrictions for small companies. Hope you have taken down. This is very important. Please write it down. Let me know if you have any doubts. Okay. Okay. Hope it is done. Okay. Next, income recognition norms. Income recognition norms. Now, just like banking companies, the banking companies, what you would have done, same thing applicable in the sense on standard assets, on performing assets, you recognize income on accrual basis. Then on non-performing assets, on NPA, or installment is due more than 12 months and all, cash basis. And because there are some investment companies, there are guidelines how to recognize income from investment also, like investment in shares, investment in debentures, how to recognize those. Okay. So next, income from investments like dividends, receivables, dividend receivables will be recognized on cash basis. Then income from bonds, debentures from corporate bodies, investment in bonds, investment in debentures, again on accrual basis. Interest from bonds, from debentures for investment in, come from bond investment in companies, corporates, accrual basis. Again, in government bonds also on accrual basis, public sector companies or governments. This is a condition that interest is predetermined, interest rate is fixed. If it is variable, you cannot recognize on accrual basis. As and when what you determine, only that extent you can recognize. Now, interest from government bonds, public sector undertakings, also you can recognize it on accrual basis. This is regarding income recognition norms. Because they have investments in shares, investments in bonds, how should they be valued? Should the difference in the market value should be transferred to P&L account, or should I wait for it the sale to happen? I'll give the this now. Okay. Hope it is done. Next category, accounting for investments. Accounting for investment. So first of all, accounting policy should be framed by the board for valuation purpose, like how to classify, how to group and all. So board should make accounting policy regarding grouping, classification, etc. What type of investment, how do you want to present it, how group, how many units to be grouped, grouping, uh, classification, etc. Grouping, subgrouping, merging categories, private companies, public company investment, fixed income investment, shares investment, preferential investment, like that. And valuation purpose or the classification, just like AS 13, we have two types of investments. One is long term investment, other is current investment. Okay, now in the long term you can have either a quoted securities, means listed in the market, listed in the stock exchange, or unquoted. In the current also you might have two categories, quoted, unquoted. In the equity shares also there, debentures also there, that will come to it later. So quoted investments in current investment should be valued at lower of cost or market value. Cost or market value, just like AS 13 rules. Unquoted shares will be valued at cost. Valued at cost. Unquoted shares and investment. Unless of course there is permanent diminution. So basically AS 13 rules will apply. Permanent diminution is there, you are going to value AS 13 rule, that will apply here. And this also long-term investment also you are going to apply the AS 13 rules, which is permanent diminution is that you are going to value it, otherwise you will value it on cost basis. That rule what we discussed in AS 13 is applicable in your group 1, I think you would have learned. That is applicable here also. That is what, cost to be valued at cost unless there is permanent diminution the value of asset. The value of asset. Okay, so this is about classification and categories. Regarding merging of categories, okay, okay, this is what the accounting for investment category is all about. Okay, so I'll go further. Next, regarding the important point is, this is all we discussed, NPA, income recognition norms. I told you income is recognized from performing assets on accrual basis or non-performing assets on cash basis. What are non-performing assets? The definition is different from a bank. For a bank, remember 90. If you have 90, if you take 90 days outstanding overdue, then it becomes non-performing assets in banking parlance. For non-banking companies, definition is slightly different. For other than hire purchase and lease companies, for NBFC, not systematically important, non-deposit, 3N, 3 nons, small company, overdue for 9 months, up to 9 months time is available. But for non-banking financial companies, systematic deposit taking companies, for them it is only 3 months. That is, they are in par with banks. For banks 90 days, These big people also like banks. These are big people, big companies, so they are like banks. So banks 90 days, these people also 3 months. Similar provision. For lease and hire purchase companies, slightly different, because lease and hire purchase companies installments are maybe monthly or installments maybe yearly, so it's slightly different applications for them. Overdue for 12 months. If money is due, not paid, 12 months, and after that only it becomes a non-performing asset. For big companies like bank, they are again like banks. For them, it is again. So please write down this chart. Okay, once it is done, please confirm. So basically, for big companies like banks, big NBFCs are similar to banks. So for them, criteria is 3 months, 90 days. For other, for lease and hire purchase companies, small but lease and hire purchase companies, who sells washing machine on hire purchase, their main objective is not selling the washing machine, not selling the TVs, not selling the laptop, but they provide finance. Lease finance, hire purchase finance. For them, it is 12 months. For other categories of small, but other categories of NBFC, small, but other MCFC is 6 months. 3 months for big NBFC, 12 months for small but higher purchase and higher purchase and lease companies, and 6 months for every other category. Once it is done, please confirm it to me. This is definition of NPA. Overdue for certain period, you become non-performing. Up to that period, you are performing. What is the consequence of becoming non-performing? A provision will increase. Provision for doubtful debts to be provided at a higher rate. At the same time, income from NPA to be recognized only on cash basis. Fine? It done? It done? Okay, next. Classification of assets. Various kinds are there: standard assets, substandard assets, doubtful assets, loss assets. Standard assets means what? Not NPA. Substandard asset means what? They are NPA for certain period. For how long? Again, small difference is there. You know what is the definition for banking companies? From the standard asset, they become non-performing assets. They will be non-performing asset. They will be in substandard asset. Then they move to the doubtful assets. Then they move to the loss assets. So for substandard asset, they remain NPA for 12 months. For non-banking, non-financing, non-deposit company, it is 18 months. This is again like bank. For non-banking financial companies, systematically important, non-deposit and deposit. Systematically important, non-deposit or deposit. Both of them are same. I told you, your deposit taking, you are important. You are not deposit. You are not taking deposits, non-deposit, but you're systematically important. Still, you are a big company. You are like a bank. Therefore, for a bank, you remain in the NPA category for 12 months, you will be in standard assets. For these also, big NBFC remaining in NPA category for 12 months, you will be in standard substandard asset. If beyond 12 months, you will move to doubtful asset. But for small NBFCs, you are not given 12 months, you are given more time. You can remain here for 18 months. 18 months period, 18 months period, you remain in NPA category. After becoming an NPA, first of all, to become NPA, how many months will be there? We discussed earlier, to become NPA, how many months? To become NPA for other small NBFCs, you will have 6 months. For lease hire purchase will come later. But for others, you can have 6 months and you can come here 12, 18 months. So basically, you have 24 months being in non-performing assets. You will not be close to, 6 months in general, 18 months in non-performing asset, till 24 months you will not go to substandard asset. Anyway, that you don't worry, that is not required. I just told you only to link the previous concept. So what is the concept? Repeat it. For a bank, if you are being a NPA for 12 months, you will be called as substandard asset. Beyond 12 months, you will be called as doubtful asset. The same provisions of banking is applicable to big NBFC. What is big NBFC? Deposit taking NBFC, non-deposit but systematically important NBFC. For these two categories, we say big NBFC. So for big NBFC, bank rules only apply, which means being an NPA for a period of 12 months, you remain in the category of substandard. Beyond 12 months in NPA, you become doubtful. What about small NBFC? NBFC, non-banking, not systematically important, non-deposit, small, everywhere small. Then you are given more time. You will not be pushed to doubtful assets. You are given more time, up to 18 months. You will be called as substandard asset, being an NPA. If you are an NPA for beyond 18 months, then you become doubtful asset. That is, when you cross this period in substandard, you become doubtful asset. Loss assets anyway, clearly marked as loss. Please write down. Write down. Standard asset means performing assets, not NP. Okay, hope it is done. I'll go further. Okay, provisioning requirements. Other than hire purchase lease, for lease hire purchase, separate provisioning requirements are there. For other NBFC, standard assets, if you are a big NBFC systematically important, maybe non-deposit or a deposit taking company like banks, big NBFC like banks. Remember the percentage for banks. For banks it was 0.4%. So here also 0.4%. For small, less provision required, 0.25%. For substandard asset, flat 10%. Remember, there in banking companies we had secured, unsecured. That category is not there. Substandard means for secured also and unsecured, for both categories is 10%. For doubtful, if it is unsecured, 100%, just like banks. But for secured less than 1 year, doubtful, secured less than 1 year, 20%, 1 to 3 years, 30%, more than 3 years, 50%. Their number was different. There it was 25, 40, 100. For banking companies, it was 25, 40, 100. But here 20, 30, 50. 20, 30, and 50. Numbers are different from banking companies. So please be careful, and no distinction between the two types of NBFC, big or small, same provision we make. For everybody, this is different from banks. Remember, this is different provision from banks. Banks provision. Bank was provision, it was 25, 50, 100. But here it is 20, 30, 50. This is for other than lease and hire purchase. For lease and hire purchase, one more set of provisions are there. We'll look at it. Okay, hope it is done. Okay, I'll go further. Any doubts here? Okay, next. For lease and hire purchase assets, I'll give you the answer. For lease and hire purchase assets, for lease and hire purchase, they have one regular provisions to be made and there should be given some additional provision to be made. Regular provisions are, of course, they have to be NPA, then only these provisions are applicable. It is to be calculated. Provision will be equal to, for regular provisions, equal to total dues, total installment due, total installment, meaning which is overdue and future installments. They say as reduced by finance charges not credited to P&L account. Financial charges yet to be credited to P&L account, yet to taken to P&L, yet to be taken to P&L. Means what? Unaccrued financial charges minus depreciated value, minus depreciated value. So in fact, this they have given. See, in the installment comprise of principal as well as interest income. A principal installment will comprise of principal as well as interest income. Now you subtract financial charges not yet created, unmatured, unaccrued. So from the interest total installment, if I take out interest, what remains? Principal. Therefore, this is nothing but book value. This is nothing but book value. Now, which means this is the current book value, amount overdue, receivable from customer, let's say 100 lakhs. And if I repossess the asset, I get depreciated value. My receivable, I have receivable from my customer now. If he is not able to make the payment, let's say housing finance companies, they have to recover the money from the not housing finance, lease hire purchase. They have given a vehicle on hire purchase basis. Let's say the person not able to make the payment, you repossess the vehicle back. So receivable amount will be replaced by the vehicle now. So book value is the loan amount replaced by the vehicle amount, depreciate value. So if you're having book value of 100 receivable, but depreciate value is only 90, the value of the asset 90, so 10 lakh you will not be able to recover. That is what the provision is, basic provision required. So depreciate value. How much depreciation? They say provide 20% under straight line method. If book value is, let's say, 100 crores, and the value of the asset when you give at the time of asset, it was, let's say, 200 crores, and 3 years over, let's say, so 20%, 20%, 20%, that is 20% or 60% would have been depreciated. That is 60% of 200, 120. Balance 80 crores would be the depreciated value. Difference between the book value and 80 crores, 20 crores provision to. So a basic concept of provisioning in lease and hire purchase is, today I'm having a book value of so much. If I repossess the goods, my book value will be replaced by the asset I have repossessed, took it back. So if the value receivable is replaced by the value of the asset, what is the difference? That should be transferred to P&L as a provision, so that my book value now reflect the value of the asset, not the receivable. Because once I take back the asset, I cannot receive money. It is like repossession hire purchase. Once I take back the asset, out of the asset, whatever is the value, that is what I need to receive. I cannot recover money from my customer anymore. Hope you got the concept. Please write down. The total installments, which is overdue and future installments, minus financial charges, yet to be taken to P&L account, which means that is what effectively book value as on date. Book value as on date. If you repossess the goods, what will be the impact? The value of receivable will be replaced by the value of the asset. Therefore, depreciate value, and they say take 20% straight line method. If it is second hand asset, then you take the cost. That Additional provisions are also to be made. We'll come to that. First, you take this much. Okay, hope it is done. Now, additional provisions, I'll give you the table now. Yeah, this is the additional provisions to be made. Additional provisions. Where higher charges and lease rentals overdue less than 12 months, nothing. Higher charges are overdue. Remember, not due, overdue. After becoming due, 12 months. Then only they become actually non-performing asset. So 12 to 24 months, 10% of book value. 24 to 36 months, 40% of book value. 36 to 48 months, 70% of book value. More than 48 months, 100% of book value. Remember like this. This is 1 year. This is 1 to 2 years. 1 to 2, 2 to 3, 3 to 4, more than 4. Number of years. And percentage incremental basis, you remember. Starting from 10 plus 30, you get 40. Plus 30, you get 70. Plus 30, you get 100. Easy to remember. 30, 30, 30. So 1 to 2 year, 2 to 3 years, 3 to 4 years, more than 4 years. 10% start, plus 30 which is 40, plus 30 which is 70, plus 30 which is 100%. So this table must be there in your material. You do not take it down. Okay. Okay. Now, one more small theory concept. You don't have to write it down. Don't write down. They can give you a small theory note. Asset liability management. It is there in study material. You can go through it. The NBFC, like banks, are heavily financed by deposits, either by a scheme or from public, and they lend it to others in the form of various investments, the form of loan, the form of equipment financing, lease, hire purchase, etc. So to maintain this loan taken or a deposit taken and amount given, you need to maintain that ratio. They call it as asset liability management. It's a risk management tool. So RBI has given you various ratios. One of them is capital adequacy ratio. They've given various ratios, various models for you to understand how the asset and liability, deposit taking and loan given, the ratio to be maintained. The model consists of interest income, expense analysis, reprice assets, basically software available. So that is, it has like gap analysis, interest rate gap analysis, net interest income analysis, the net interest margin analysis, tolerance analysis, cost to close analysis. So various kinds of ratios are given, like cost incurred to obtain the asset, advertisement incurred to get the asset, how much amount you're receiving on time or not, what is overdue, how long customer is paying, what time they're taking on an average. All those kind of analysis for this tool is provided, basically a software along with the list of ratios, a model given. Anyway, don't worry too much. Just be aware. If they ask you short notes, you should be able to write 3-4 sentences. Fine? Okay. One concept called as minimum net owned funds. An NBFC should have a minimum net owned funds of 200 lakhs. Some other category of NBFC should have some other amount, but basic category of NBFC should have minimum net owned funds of 200 lakhs. Okay. So what is net owned funds? Net owned funds, like shareholders funds. Net owned funds is comprising of owned funds minus investments in subsidiaries in the form of shares or debentures. Investment in subsidiaries. What is owned funds? Owned funds comprises of like a shareholders funds. In the sense, it is comprising of paid up share capital plus free reserves minus any fictitious assets. like debit balance of P&L account, deferred revenue expenditure, other intangible assets like this. So fictitious assets and intangible assets should be subtracted. Okay, this is owned funds. Now owned funds you have to subtract investment in subsidiaries. Not every investment. How much investment should be subtracted? It is actual investment, only excess amount. Excess only to be subtracted. How do you calculate the excess? 10% of owned funds, some amount. Then actual investments, investment in shares and debentures. Excess amount is to be subtracted. Excess amount is to be subtracted from the own funds. That will give you the net owned funds. For example, if I say owned fund, let's say 100 lakhs, and the investment in subsidiary, let's say, is 12. Actual investment is 12. So 10% of own funds, that is 10% of 100 is 10. So 10 is allowed, but you have invested 12. So excess is 2. Excess 2 subtracted from 100. So net owned funds becomes 98. So basically it means up to 10% of the net owned funds you can invest in the investment in shares of or debentures of subsidiary company. If you invest more, the excess amount should be subtracted from net owned funds. That's called as that should be subtracted from owned funds, and difference is called as net owned funds. And minimum should be 200 lakhs for NBFC. They fall below, of course, they have their consequence. Okay, so hope you are fine till here. Essential norms are discussed. Okay. Okay. So come to this problem. Come to this problem. LK Finance Limited is a non-banking finance company. It provides you the following information regarding its outstanding amount. Rupees 400 lakhs of which installments are overdue on 400 accounts for last 2 months. Amount overdue 80 lakhs. On 24 accounts for 3 months. Amount overdue 48. On 10 accounts for more than 30 months. Amount overdue 40 months. And on 4 accounts more than 3 years. More than 3 years. Amount overdue 40 lakhs. Already identified as substandard asset. And one account of 20 lakhs has been identified as non-recoverable by management, means loss assets. Out of 10 accounts overdue for more than 10 months, 6 accounts are already identified as substandard and amount is 12 lakhs for more than 14 months, and other identified as substandard asset for a period less than 14 months. Classify the assets of the company in line with non-banking financial company, systematically important non-deposit taking company, and the deposit taking company direction for 2006 or Reserve Bank 2006. Okay, let's write down one by one. What are the different types of assets we have? Total amount is 400, right? Total amount due is 400. Total amount due is 400. So we will have different types of assets. You know what are different types of assets we have? Standard assets, then we have substandard assets, Then we have doubtful assets. Doubtful assets require more lines. Then loss assets. They just ask us to categorize it. We'll categorize it. And total overdue. You know, total overdue. Total outstanding amount, not overdue, total outstanding. Total outstanding 400 lakhs. Rupees in lakhs. Okay. Now let's write down one by one what are the information given. Total should be 400. One by one should add up. Okay. Now what information they have given first? Amount overdue 80 lakhs. Now amount overdue 80 lakhs are for 2 months. Overdue for 2 months, do you think it become non-performing assets? Overdue for 2 months, do you think it's become non-performing asset? No, they have to become 3 months for bank, and yeah, 3 months for this is like bank only. So 3 months for others, 6 months for hire purchase, 12 months. But this is as per systematically important non-deposit and deposit taking. So they are like banks only. So whatever provisions applicable for banks, same thing applies. For overdue for 2 months, they will not become NPE. So we will write under standard assets. Under standard assets, we will write how many accounts are there? 400 accounts. 400 accounts overdue for less than 10 months. Due for overdue for less than 2 months. Less than 2 months. That is total amount overdue 80 lakhs. 80 lakhs. They are not non-performing assets. They are standard assets. And 24 accounts for 3 months. 3 months also is not there. Only when you cross 3 months you become non-performing. Up to 3 months you are not non-performing. So 24 accounts overdue for less than or equal to 3 months, 48 lakh. 48 lakh. Okay, next. Then on 10 accounts for more than 30 months, amount overdue 40 lakhs. More than 30 months. And there's some information of the accounts. 10 accounts overdue more than 30 months, 6 accounts are already identified as substandard. Okay, let me give a simple chart here. 10 accounts are more than 30 months. Amount is 40 lakhs. Of this, already identified as substandard assets. 10 accounts more than amount overdue 40 lakhs. Of the 10 accounts overdue for more than 30 months, which is what is this connected with this, 6 accounts are already identified as substandard, 12 months. 6 accounts are already identified as substandard for more than 14 months. Accounts for substandard for 14 months. That amount is 12 lakhs. Another thing is when this was given at that point in time, that was the category was 14 months. Now it is 12 months. Remember this problem, it was 14 months earlier, now it is 12 months. Now the category is 12 months. So I'm solving the problem. as given in the solution by ICI. But as on date, they will not give the number 14 months. Now they will give the word for, they will give the number 12 months. Just keep it in mind. So 6 substandard asset already identified as substandard, 12 lakhs. So this will become now they have crossed 14 lakhs. No, already 14 lakhs, already 14 months. This is more than 14 months now. It was already 14 months, now more than 14 months. So they become more than 12 months. More than 12 months means they become doubtful now. From the substandard, they are moving into doubtful. They become doubtful. It was 14 months earlier, now it is 12 months. I gave the question as it is, but if the question to be given today, they will not give the number 14 months. They will give the number 12 months because 14 is revised to 12 months now. Keep it in mind. 6 accounts substandard. Remaining total of 4 accounts were there, 10 accounts were there, 6 we took it. Remaining 4 accounts accounting for 40 minus 12, 28 lakhs. They are more than 30 months. Accounts for more than 30 months. Okay, and others are substandard assets for a period of less than 14 months. So others are substandard assets. Less than 14 months. See, these are all average more than 30 months. That's why they are giving up the breakup. This is substandard asset less than 14 months. Again, now it will be 12 months. Remember, okay? Now it will be 12 months. The criteria will be 12 months. This will be substandard asset. So let's write down under substandard assets. Under substandard assets, this 4 accounts. 4 accounts for overdue less than 14 months. Remember, now it will be 12 months. This number now, if they ask you the examination question now it will be 12 months. As per this question 14, I'll keep it as 14 because it was asked at that point in time. Now it is 12 months as on date. So 4 accounts less than 14 months, 28 lakhs. And balance 6 lakh, that is 6 accounts overdue more than 14 months. Now it will be 12 months again. This criteria will be now 12 months. This is 12 lakhs. That's how we accounted 12 and 28. Okay, and 4 accounts for more than 3 years. 4 accounts for more than 3 years, that category will come. So this is doubtful debts. Which category? This will be category, okay, less than 12 months. This is substandard doubtful for less than 1 year. Okay, this will be doubtful for less than 1 year. Because substandard, don't worry, when they come to doubtful, they have just came to doubtful now. So less than 1. Okay. Now, this is done. 1 account, okay. Then 4 accounts are more than 3 years, identified as substandard assets. So 4 accounts, another 4 accounts overdue more than 3 years. They have given, right? More than 3 years. For more than 3 years. For more than 3 years. And already identified as substandard asset. 40 lakh. Then 1 account loss assets. Non-recoverable loss assets, 20 lakh. 1 account loss assets, 20 lakh. 1 account loss assets, 20 lakh. So everything is fine. So only what is pending is the remaining accounts, standard assets. So for overdue balancing figure, accounts, other accounts performing, no overdues basically. Overdue less than, this was 2 months, right? This was exactly 2 months. For last 2 months, okay, this is less than 2 months. This was overdue for 2 months. It was overdue for 3 months. This is less than 2 months. Balancing figure. Tell me how much balancing figure comes to, because total should be 400. Total should be 400. Tell me balancing figure. 400 minus 20 minus 40 minus 12 minus 28 minus 48 minus 8. So balancing figure 172. 170. You can give total also for your reference if you want. This is coming to 300. Okay, we'll go further. Okay, so come to this problem. Come to this problem. Samveda Limited is a non-banking finance company. It accepts deposits and also deals in hire purchase business. It provides you the following information regarding major hire purchase deals on 31st of March. Few machines were sold on hire purchase basis. The hire purchase basis was set at 100 lakhs as against the cash price of 80 lakhs. The amount was payable was rupees 20 lakhs, down payment, and the balance in 5 equal installments. The hire vendor collected the first installment on the 1st March 2012, but could not collect the second installment, which was due on the 1st of March 2013. The company was finalizing the accounts for the year ending 31st March 2013. Till 15th May, the date on which the board of directors signed the accounts, second installment was not collected. Presume IRR to be 10.42% required. What should be the principal outstanding on 1/4/2012? Should the company recognize the financial charge for the year 12/13 as income? What should be the net book value of asset on the 1st of March 13 for Samvedan Limited is concerned as per NBFC prudential norms requirements for provision. Okay, so read the problem once more. Read the problem once more. Okay, so they are basically into hire purchase business. Okay, and they have given on 31st March 2011 Some sold on higher purchase basis. Higher purchase price was 100 lakhs. Cash price is 80 lakhs. Higher purchase price 100 lakhs. Everything rupees in lakhs. Cash price 80 lakhs. Okay, when you sell initially, you pass a journal entry. What journal entry you pass? Like amount receivable, or like customer account debit, amount receivable to sales or to loan given. How much amount will you write on the date of sale, on the date of finance? You don't say to sales or to whatever the to finance, to loan provided. So higher purchase price is 100 lakhs. Cash price is 80 lakhs. On 31st of March 2011, few machines were sold on higher purchase basis. Let's say, for time being, let's say sales only. Customer account debit to sales on higher purchase basis. Can you please tell me how much amount you are going to credit? 100 or 80 on the date of sales, customer account receivable, data to sales. Will you do 100 lakhs or 80 lakhs? You would have done the higher purchase already in group 1. 80 lakhs, right? You will do only 80 lakhs. 80 lakhs. Now, installments, okay, down payment. Down payment, how much? Amount payable was 20 lakh as down payment. Down payment means what? You will pass an entry, bank account to customer 20 lakh. So what is the remaining receivable? Remaining to be collected in the form of installments. The form of installments, out of 80 lakhs, 20 lakhs you collected already. Remaining 60 lakh is what you have to collect in the form of installments. But installment should include interest, and they said equal installments. And installments is usually will be equal only. Balance in 5 equal installments. 5 equal installments. Tell me, can I do 60 lakh divided by 5? You should not do. Remember basic concepts. How do you calculate installments? The loan amount is always calculated as whatever installment multiplied by annuity factor. Equal installments, present value money concept. Annuity into annuity factor is present value. Remember, present value is calculated as annual cash flow multiplied by annuity factor. So how do you calculate installment? Installment is calculated by loan amount divided by annuity factor. In this case, what is the loan amount? Amount of loan, amount to be collected 60 lakh, amount to be received 60 lakh in the form of installments, divided by annuity factor. How do you calculate annuity factor? At 10.2%, 10.42% for 5 years, because they said 5 installments. Tell me how much you get. 60 lakh divided by how much? Annuity factor at 10.42% for 5. How do you calculate? 1 divided by 1.1042 press equals to 5 times GT. How much you get? Present annuity factor. Tell me how much you get. 3.7505, right? 3.7505. So 60 lakh divided by 3.7505, 15.99, and let's say approximately 16 lakhs. Approximately 16 lakhs. Approximately 16 lakhs. Now look at this in this problem. Coincidentally, you get one more answer, but that's not the right answer. Coincidentally, you get higher purchase price is 100 lakhs. Higher purchase price is 100 lakhs. Down payment 20 lakh. The remaining 80 divided by 5 installments. You get 16. The same answer 16, but this is just a coincidence. This is not every time, remember. So let's not follow this method. What I read in written in red, that is only for your reference. That's not a conceptual method. 100 lakhs higher purchase minus down payment 20, 80 balance by 5 installment 16. But that is not the right method at all. Hope you got it correctly. Is it done till here? Shall I go further? Please confirm. Okay. Now let's go for all the accounting now. So on 31st of March 2011, amount value of sales was 60 lakhs minus received 20 lakh down payment. So balance receive 80 lakhs. 60 lakh minus 20. So 80 minus 20. Okay. So 80 lakh is sale value minus 20 lakh you receive. So balance receivable 60 lakh. This is as on 31st March 2011 or date of sale. Then for the year 2011-12, interest due. Interest due 1 year on 60 lakh, 10.42%. How much you get? 10 lakh into 10.42%. 6.25. Okay, 6.25 lakhs. Let's say 6.25 lakh. Let's say rupees in lakhs everywhere. Now, you collected the installment. I think the first installment was collected. 31/3/2012 collected. So 31/3/2012 first installment collected, received. Installment amount is 16 lakhs, so you can collect it. So what is the balance due? 60 plus 2.25 minus 16. 60 lakh plus 2.25 minus 16. So 6.25, no, not 2.25, 6.25. 60 plus 6.25 minus 16. 60 plus 6.25 minus 16. 6.25 was the interest. 6.25 minus 16. Get 50.25. 50.25. Then for the year 2012-13, interest accrued. Let's say interest accrued. On 50.25, 10.42%. On 50.25, 10.42%. Tell me how much you get. 5.24. 5.24. So as on 31st of March 2013, balance due for the year ending 31st March 2022, second installment was not collected, could not be collected. Second installment could not be collected. So no collection. Second installment, 0. 0. So balance due. How much is balance due? 50.25 plus 5.24, 55.49. Now, tell me this. This is overdue for how long period? Now, this second installment was due but not paid. So, it's called as overdue. For overdue for how long period? For overdue for how many days? Don't tell me 12 months. It was due on 31st of March 2013 and not yet paid. So, overdue for one day only, you can say maximum. Overdue only for one day. Remember, because the due date which was supposed to be paid is on 31st March 2013. First installment was due on 31st March 2012. Second installment was due on 31st March 2013. Second installment not paid. So due date was 31st March 2013, not paid, and we are on 31st March 2013. So overdue for only one day. It's not a non-performing asset. So for the year 2012-13, overdue is only for one day. In fact, it's not even one day. Maximum, let's say, overdue for one day. Hence, asset is not non-performing asset. Asset is performing asset. Standard asset. Not an NPA. Not an NPA. Hence, interest income that is recognized how much? 5.24. 5.24 for this year, for the year 12-13, to be recognized on accrual basis. To be recognized on accrual basis. Income to be recognized, that is fine. Income to be recognized. But regarding provisions, what about already made? This is income, okay, no, this income to be recognized, but we have to make a provisions. Interest income recognized on accrual basis because this is a standard asset, completely fine. Next year, 1 year, 2 year later, if it is still an NPA, amount not collected, okay, we don't recognize income on accrual basis. But this is one part of the problem. Other part is there, provisioning requirements are also there. What should be the principal outstanding on 1/4/2012? Should the company recognize the financial charges? Yes. For the they've asked for 1st of April 2012, which I have done. Balance outstanding. This is the first part of the problem. Balance outstanding. 1/4/2012. And they're asking, should the recognize financial charges for their 12th income? Yes. They should charge, yes. Interest income should be charged, yes. Interest income should be charged on accrual basis, to be recognized on accrual basis, because it is not an NPA yet, overdue only for 1 day. Hope it is clear. Okay, next. Now this is income recognized, but provisioning requirements are there. Provisioning requirements are two kinds. What are provisioning requirements? Two kinds of provisioning requirements. Provision requirements. One provision. Remember, amount overdue plus future installments minus interest not yet credited to P&L, not yet credited to P&L, and whole minus depreciated value, and additional provision to be made. Additional provision in the sense, since it is less overdue for less than 12 months, overdue for less than 12 months, overdue for only 1 day, this will be 0. But first provisions will come. First provision will come. Amount overdue plus future installments minus interest credited. Future installments minus interest not yet credited. Interest not yet credited means interest to come in future years. Oh, for that we should do this one. Loan repayment schedule. Loan repayment schedule. Remember, in leasing and all we are done. Here, opening balance, then interest income for the year, then installment, closing balance. So we have started with the year 2011-12. First year 2011-12, 2012-13, 2013-14, 2014-15, 2015-16. Opening balance. How much opening balance due after this amount to be collected? 60 lakhs. Interest income at 10.42% for first year, already told me. 6.25. Installment 16. Every month, every year installment is 16. Then closing balance. First we already got 50.25. That is 60 plus 6.25 minus 60. Next 50.25. On this 10.42% interest income at IRR 10.42%, which you already calculated actually 5.24 minus 16. This is if collected. Okay, this if everything collect on time. Can you tell me what the closing balance comes to? 50.25 plus 5.24 minus 16. Get 39.49. Okay, 39.49. Now this becomes opening balance 39.49. On that 10.42%, please tell me. On that 10.42%, you get 4.11, I think. So 39.49 plus 4.11 minus 16 equals 27.6. And 27.6 will be the opening balance on the 10.42%, 2.88. So 27.6 plus 2.88 minus 16 equals 14.48. Last year 14.48 plus something should be equal, but last year should be 0. So balancing figure I'll make it 1.52. Balancing figure. Hope all of you getting same numbers? Okay. So they want future installments. See, this installment was due, second installment not received. This is called as overdue installment. This is future installments. Okay. Now this interest, this is yet to happen because we are preparing the accounts as on 31st March 2013. So this is yet to be credited. Yet to be credited. Can you please tell me now how much you get? Future installments is 48, 16, 16, 16. This 4.11, 2.88, 1.52. Can you tell me the total how much you get? 4.11, 2.88, 1.52. How much yet to be credited? Is not received, overdue. 4.11 plus 2.88 plus 1.52. Only this much I'm asking. Interest only. 4.11, 2.88, 1.52. Only those three I'm asking. 4.11, 2.88, 1.52. 8.51. This is the interest income which will come in the future years. It will accrue in the future years, time value of money, but not yet created. So coming back, so amount overdue. Amount overdue, this installment not yet collected, 16. Amount overdue, 16. Plus future installments. Future installments are 16, 16, 16. Total 48. Minus interest not yet created. That is what? Interest not yet created. 4.11, 2.88, 1.5. You told me 8.51. 8.51. Then minus depreciated value. We'll come to depreciated value, but tell me this number. How much this is coming to? 16 plus 48 minus 8.51. 16 plus 48 minus 8.51. 55.49. And this is nothing but the book value what we have calculated already, 55.49. So much circus was not required. In the exam, don't do all these things. In the exam, don't do all these things. Unnecessary waste of time. I told you for conceptual purpose. Exam, what do? You just take the book value only. Whatever 55.49, you take it. The logic is installment includes interest. In the installment, if I take out the interest, I get principal amount, which is what amount outstanding now. Anyway, so in the examination, all these three put together, you simply take it as book value as on date. No need to do all those big calculation, not required. I did only for conceptual purpose. Examination not required so much. Here now depreciated value. Depreciated value. How many years are over? The cost of the asset is 80 lakhs. Original cost cash price 80 lakhs. Depreciation to be brought 20% fixed for 2 years. So depreciated value, I'll write it here. Depreciated value. Original cost 80 cash price 80 lakhs minus depreciation at 20%. 2 years are over for the year 2011-12, for the year 2012-13. That is 16, 20% of 80. Again 6. So 40. So depreciated value 40. So what is the provision becomes? 55.49 minus 48. That becomes 7.49. The total provision to be made, total provision 7.49 plus 0, because additional provision 0, overdue less than 12 months 0, 7.4. 7. So what will be the value of the asset after provisioning? Value of receivables after provisioning. Book value was 55.49, we made a provision of 7.49, so that became 40. So effectively, now it's reflecting the book value of the asset. So what is the logic I told you? Today, if you repossess the asset, your receivable will be replaced by the asset. Receivable will go out, asset will come in. So whatever the asset you have got it, that asset should be reflected as book value. That is what is 48 all about. If you got the conceptual part, so please write down if you have any doubts. Okay, hope it is done. Can you please confirm? Is it done? Okay, we'll go further then. Okay, so come to this problem. While closing the books of accounts on 31st March 2005, NBFC has its advances classified as follows: substandard assets, substandard assets, secured position of doubtful assets up to 1 year, 1 to 3 years, more than 3 years, unsecured portion of doubtful assets, loss assets. Calculate the amount of provision which must be made against advances. You know the provisions. Standard assets 0.25%. Substandard assets, secured, unsecured does not matter, 10. And this is unsecured 100, loss 100. This is up to 1 year, less than 1 year, 1 to 3 year, more than 3 years, 20, 30, 50. So apply those provisions. And standard assets, we are assuming 0.25%. Why not 0.4? Because I'm assuming this NBFC is non-deposit and not systematically important. In the sense, we are assuming it's a small company. So 0.25%. But if you assume NBFC as deposit taking or non-deposit but systematically important. Non-deposit but systematically important. Since the net worth more than 500 crores, then it becomes big company, big NBFC. So what percentage applicable? The percentage applicable will be then 0.4% as per the RBI provisions, RBI directions. 0.4% would apply. 0.4%. So we are assuming non-deposit, non-systematically important, so 0.25%, else it would have become 0.4%. Substandard assets 10% is flat, secured 20, 30, 50, doubtful assets unsecured 100, loss assets 100. Please compute if you are able to get these amounts total. Okay, hope it is done. Shall we go further?